Good evening, everyone. It's 7 o'clock. It's time again for our discussion group. Okay, before we start, let me give a brief introduction to the speaker, Kristen Jacks. Kristen Jacks is a financial educator, author, and the founder of Money in Your 20s. Kristen worked for Kiplinger Personal Finance Magazine and Mutual Fund Magazine before becoming a writer and a speaker. Her new book on investing is a lively and jargon-free resource for young adults or anyone new to investing. Kristen is a graduate of Duke University. Today's topic is sector investment. Now let me turn the screen to Kristen. Thank you, Kristen.
Thank you, Young, and thank you, Greenwich Library, for all your fantastic programming. It's such a pleasure to work with you guys. Welcome, everybody. This is the Investing Discussion Group. This is actually our third season, hard to believe. And the theme of this season has been based on your requests. So last year, we kind of reached out and talked about what you guys most wanted to hear. The economy was a big topic. Saving on taxes is always a big topic. Everyone loves the psychology of investing, behavioral finance, cognitive biases, things like that. We also want to do diversification, asset allocation. So we did all of these things, and we're kind of nearing the end. I mean, we only have 3 sessions left, including this one. But hopefully you've enjoyed the discussion group. And if you've missed anything, all of these discussions live on the library's YouTube channel. Young always says they also live on the library's website. I personally just find it easier to go to YouTube if you're used to YouTube, because all you have to do is in the search bar for YouTube, enter Greenwich Library, and then a few things will pop up, but what you're looking for is this green and white logo that's like an open book with like the outline of a tree. And if you click on that, it takes you to the Greenwich Library YouTube channel. And it's very easy to find the videos. The videos are just right there. And we've had some really wonderful videos. 2 years ago, we were really focused on books, like The Psychology of Money was a huge hit, The Bond King, things like that. And then last year was more topics. And then this past season, we've really been doing all these things that you guys have requested about, saving on taxes, the economy, affording college, things like that. So you can find all of that stuff on the YouTube channel. Okay, so today we're covering sector investing and then planning ahead. We hope you'll join us May 13th for the psychology of investing. I think that's going to be really popular. People love that. So welcome everybody. And just a quick disclaimer, this webinar is for educational purposes only. It is not intended to provide investment advice. None of the investments mentioned in this discussion group are recommended or discouraged. Before making financial decisions, you are urged to consult a wide range of professionals, tax expert, lawyer, financial advisor, who are aware of your unique needs and situation. Okay. And also, please participate. This is the discussion group. I know it's a little hard to do sometimes on Zoom. If you're shy, you can always just put a message in the chat. But you can also unmute and just ask a question. So sometimes if we have background noise, though, we will mute you. Don't take it personally. It's just sometimes you forget you're unmuted and then, your kid comes in and asks you a question and things like that. So if there's background noise, we'll mute you, but feel free to unmute and ask a question or give a comment. Or if you know something that's really been working, please go ahead. Okay. The S&P 500. Why are we here tonight, right? What's going on? What's the point of tonight? So why even learn about sectors? Well, the thing about sectors is if you start breaking the S&P 500 down into sectors, then you really get a sense of like our broader economy, right? And why would you need that? Well, here's the problem that what has turned into a problem because of the weighted nature of the S&P 500. So a lot of people think they're fine if they just invest in the top 500 companies in the United States by purchasing the S&P 500, as a mutual fund, as an ETF, whatever. They're in the S&P 500, and what they think they get is this just orderly, lovely distribution of these wonderful American companies like Starbucks and IBM and Ford and the Hartford and Walmart and Aflac and FedEx and Netflix and Procter and Gamble. I mean, I just love looking at these logos. I just love just the innovation in this country, the hard work in this country. And why not? The S&P 500, it just feels terrific, right? It's like all, don't overthink it. Just jump on the bandwagon, take this popular investment and go with it. Now you're in the best companies in America, right? Okay, so that's what you think you get. That's what people seem to think they get. They get this nice smattering, right? But here's the reality. This is really what you get because of the effect of cap weighting. And what I mean by cap weighting is that, every stock has a market capitalization, meaning you take the number of shares of that stock that are outstanding, and then you take its share price, which is constantly moving around, as we know, and you take the number of shares, you take the share price, you multiply them, and then that gives you a number. Sometimes it's an enormous number. Sometimes it's in the trillions, right? Like you have Apple is a $2.6 trillion company right now. Sometimes that number is much smaller, right? So you can, and it could be still a very large company, but it's not 2.6 trillion. It's maybe 30 billion, right? That's a dramatic difference. Still a large company, but a dramatic difference. Well, the way the S&P 500 index works, unless you intentionally buy an equal weighted S&P 500, which most people don't do. A lot of people don't even know that exists. If you just buy a regular S&P 500 fund, it's going to be cap weighted. So then what happens is the mega companies dominate, meaning like the dollars that you're investing are connected to these enormous companies. You're getting a share of these enormous companies, and you're getting hardly any of these other companies that you probably really like Ford and Pfizer and Aflac and Starbucks. You thought you were getting this, right? You thought you were getting some kind of like even distribution of all these great American companies, but that's not what you're getting. You're getting this. You're getting an enormous amount. Like if you think about it, it's the S&P 500. It's supposed to be an investment distributed over 500 companies, right? So if it's distributed over 500 companies, how can 7% of the S&P 500 just be Apple? How could 6% just be NVIDIA, right? That's surprising, right? But this is what's happened because of cap weighting. So honestly, you're getting a lot of Apple, NVIDIA, Microsoft, Amazon, Tesla, Meta, Google, Netflix. This is what you're getting, right? And you're getting hardly any of these other companies. So honestly, for you to be investing, you must understand the impact of cap weighting, because that's what goes on in almost all the index funds, whether it's a mid-cap fund or a small-cap fund, a large-cap fund like the S&P 500. That's what's going on inside of indexing. And, to put it another way, the S&P 500, if you took the top 20 companies in the S&P 500, they are 45% of the entire index. And the bottom 100 companies, which are still large companies because they're still the top 500 companies by size in the United States, they are only 3% of the index. So you're really not getting those companies at all. So like, just to keep it visual, because some people don't really love the numbers. So you're getting a lot of Apple, NVIDIA, Microsoft, Amazon, Meta, right? So information technology is one of the sectors we're going to talk about tonight. So we're going to, the S&P 500 is comprised of 11 different sectors, and we're going to learn all the sectors tonight. Information technology is one of the 11 sectors. But right now, because of cap weighting, it is 30.7% of the S&P 500 is just information technology companies. It's very, very concentrated. S&P 500 is very, very concentrated in a handful of companies that are information technology. And meanwhile, even though you thought you could sort of set it and forget it, just buy the S&P 500, depending on what your goals are, you're really not getting certain things that are very important, right? Like if you have any interest in getting any kind of income, I mean, John Bogle, who's a famous investor who started Vanguard, he claimed in one of his books that was written in the 90s that really like half of all of the returns of stocks used to be dividends, right? That used to be, yes, you would have like a price appreciation, the stock would go up over a long period of time, but half of your gain was dividends. That is no longer true at all. The S&P 500 has a dismal track record of giving you dividends. The S&P 500 is going to give you a 1.3% dividend. That's compared to the risk-free rate of just buying treasuries from the government. I mean, it's dismal. So depending on what your goals are, like you can't just set it and forget it. You kind of have to understand what you're getting with the S&P 500 and how having a better appreciation of sectors and how to use them could, kind of fix your portfolio if you're worried about the concentration, or certainly fix your portfolio if you need more income. And we're going to talk about all these things. But right now, I really want you to understand that there are terrific companies that you're hardly getting any of, like Zoom and Aflac and Ulta Beauty and UPS. You're just not getting them through the S&P 500 when you think you probably are. Okay, and then, you also just miss opportunities, right? Like Aflac and the Hartford Insurance Group, these are two companies that in the last 5 years have just zoomed ahead, just such a and they're just really well-run companies and they have really good balance sheets and they're, and they've just zoomed ahead. But since the S&P 500 owns hardly any of either of these companies, you haven't benefited from that. So, either information technology does well and you do well, and then, what's going on in these other areas of the economy, you're just not, you're not taking advantage of it. You're not getting the advantage. And also the low income is, in my mind, a huge problem, right? If you want to have income from your investments, you are definitely not getting that through the S&P 500. So, what I'm talking about are dividends, right? When I'm talking about income, you're just not getting that. Okay. And also, I mean, to keep in mind, right? So when we talk about the sectors are still going to be, parts of the S&P 500. The S&P 500 is only large cap stocks, right? So when I talk about cap, I'm talking about capitalization. I'm talking about this concept of like, a company is worth its shares outstanding multiplied by its current stock price, right? That gives you a market capitalization. And, S&P 500 is the 500 largest companies in the United States. So you're getting the big, really big ones. There are a lot of medium-sized companies that are fantastic that you're not getting. There are a lot of small cap companies that are the up and comers, that are the future growth company. The ones that 10 years from now are going to be the large cap companies. You're not getting those at all. So if you're only doing the S&P 500, you were only getting large cap stocks, which in, kind of theories about being diversified, you should also be getting mid cap companies. You should also be getting small cap companies, and you're not. You're also only getting the United States. So you're not getting foreign at all. So you're really, you weren't diversified to begin with if you're only doing the S&P 500. And it's become so concentrated because of cap weighting. So we're going to talk about sectors, but then just toward the end, I'm going to also mention again the mid cap stocks, the small cap stocks, and the international, because you really want to be well diversified. I know it hasn't seemed that way. I was listening to a podcast and they were joking that it was the theme of the last several years has been SPY or die. So if you know what that means, SPY, SPY, is the ticker symbol for the ETF for the S&P 500. It's like the kind of the most popular ticker symbol or ETF. The way if you're going to use an ETF, it's the most popular way to get the S&P 500. So SPY or die, because what's been working has been, these information technology companies, the Apples, the Nvidias, the Metas, all that stuff, they have been working. And unfortunately, that sometimes is self-perpetuating because people tend to chase returns. But when it's over, and that can be really scary. So there's this guy, David Gardner, who runs the Motley Fool, which is, I mean, a website. I don't know how you describe it, but they give, they dispense investing advice. They're pretty popular. And he likes to say that stocks take the stairs up and the elevator down. And that's kind of what we're seeing right now. Stocks can slowly climb, but boy, when they fall fast. I mean, the last couple of trading days have been so unsettling, especially if you hold Apple or you hold Nvidia. I mean, they've just been plummeting. So yeah, so again, like, let's work on being diversified and not just have all our eggs in one basket. Okay, so what's the best use of the time we have left? We have a little less than 80 minutes left. Okay. So I think it's really always helpful to understand how we got here, right? So believe it or not, there were no index funds 52 years ago. This whole passive investing, people are predominantly in index funds. That's just really changed. The whole landscape has changed. And I'm not even saying like versus, like it used to be like mutual funds versus ETFs, things like that. I'm just saying this whole idea of like someone would build an index and then there'd be a way to like capture the top 500 companies in the United States through one investment vehicle. That just didn't exist. Indexes really didn't exist. So why and what was going on in the 1970s that just sort of forced all these changes? I think it's really interesting to know what the problems were and how index funds were supposed to address the problem. And they fixed one problem, but now they've created others. So we're going to do a quick history lesson. Then we're going to introduce the sectors, the 11 sectors. We're going to talk about the sectors that are wildly underrepresented when you have the S&P 500, because if you have information technology, one of the 11 sectors being 30%, then it kind of stands to reason that those numbers have to come, the shortfall has to be made up. So, or there has to be a shortfall somewhere for there to be this massive overweighting in one area. And then we're going to talk about what not to do, because when you're dealing with sectors and maybe you're not familiar with them, one thing people often do is like, oh, okay, I get it that some sectors aren't represented. Let me just find out like which sectors have been the hottest recently, and I'll just invest in those. And so that's usually the worst thing that you can do, because chasing returns has abysmal results. So we're going to never chase returns, and we're going to talk about what not to do and what to do. And then let's talk about getting even more diversity in there, right? The 11 sectors, that's great. Make your investments in the American economy more balanced. But then think about mid-cap stocks, think about small cap stocks, think about international. And then also, if income is your goal, then you're really going to have a very specific strategy. And then, of course, we can always do question and answer, and anyone at any time can put questions in the chat or unmute. And please, you really can unmute and just say, hi, I have a question. Okay. So I love a good history lesson, right? So in the beginning of the 1970s, the way the way investing worked is so completely different from what we are experiencing now, okay? Commissions on trades, right? When you decided you did want to buy something, the commissions were 8%. It's astonishing to think. So obviously, like you're buying something, you're buying it, you're definitely putting a lot of money out there all at once, and then 8% of it is getting taken. That was a problem that needed to be solved. Then you had the problem of brokers, they're convincing you to buy something, and then they make money on the commissions, right? So they like to buy and sell. At that point, there was this feeling that these brokers were not the most reputable. They didn't have your best interests at heart. So since they wanted the commissions, they'd be like, oh, that stock, that's no longer a winner. Like, let me get you out of that. Let me get you into this. And they'd, generate more commissions, but they'd create this churn, which had nightmare tax consequences, right? Because of, tax laws, short-term gains, long-term gains, all those things. So this was not a good system, right? So the incentives were not aligned, let us say. Like the brokers wanted to make more trades to get the commissions. You necessarily wouldn't want that. There were no 401ks, right? So you didn't have this whole system of like periodically, personally, putting part of your paycheck into investments and being kind of protected from bad commissions, but also protected from taxes, right? That whole 401k umbrella didn't exist. And there were no fractional shares, right? So the way things work today, where you have no commissions, you can buy like a very small amount of stock at your discretion. So you can either like through your work, through your 401k, just kind of chug along, making these periodic, these sort of installment investments, not really be paying much. I mean, you're not really paying commissions. I mean, you're paying, modest fees for, to have this 401k, to have these assets. But everything was completely different back then, and not in a good way. So because of these problems, people were coming forward and saying, we need a different system. This system does not really look out for investors. So people, that was bubbling up. People were saying that. And then a horrible bear market occurred. So from January 1973 to December 1974, a lot of people don't know this, the S&P 500 plunged 48% in one of the most punishing bear markets of the post-war era. So you can imagine you already have a system where investors are not terribly happy because of high commissions and not terribly happy because of bad tax consequences. Now they've been completely pummeled. People don't tend to complain that much as long as the market's going up. It's like, maybe I'm not making that much money because of the commissions. Maybe I'm getting a little bit messed up on taxes, but hey, I'm making money. Well, if you have a 2-year period where you've lost basically half of the value of your account, now people are furious. They are disgruntled. They are disappointed. At one point in 1979, Business Week ran a cover story called The Death of Equities. The cover story was literally called The Death of Equities. I mean, the 70s were so abysmal. People were so frustrated. But when things like that happen, when problems arise, then you have innovation and you have change. And so there were big changes coming in the mid 1970s. And one of the biggest voices at the time was John Bogle, who's, eventually he starts Vanguard, right? He comes out of Princeton. Even as he's a student in Princeton, he's like, these investments, they just don't work, right? People don't get, you really don't end up beating the market, and people are just getting messed up on commissions and taxes. And, what we need is like a product, an asset that people can buy, at a low cost, and there's hardly any churn, right? There's hardly any trading in and out. It just mirrors the market, right? So John Bogle was very passionate about that. And he wanted to be I give him credit for the first index fund. Technically, it really goes to these guys at Wells Fargo, I guess, but I'm just going to forget about them because that was for institutions and not for individuals. But John Bogle was like leading the charge on, let's create a product that's low cost, that doesn't have the churn, that just reflects the market, and let's give people something that would really, really help the average investor. And I, think he was a brilliant guy. So he starts this in 1976. I mean, people are basically laughing at him. I mean, the idea, all of these brokers thinking, they have their analysts, they have their hot stock picks, they have their way of doing things. Why would anybody ever want to just mirror just the market? I mean, that's just kind of like you're guaranteeing you're getting an average return. It's sort of like, that's un-American. You just want to mirror the market. You just want to get average. We have all these brilliant minds and analysts who are coming up with the hot stock picks, which turned out to not be so hot, since a lot of research was showing that like very few of these fund managers and teams or whatever were beating the market. So John Bogle was like, we got to get out there. We have to create these index funds. And, meanwhile, Charles Schwab was created. I mean, believe it or not, there was no Charles Schwab. There was no Schwab. And he created discount brokers and the whole discount brokerage idea of getting stocks at a lower cost. So there were all these things going on that were big changes. And then out of the University of Chicago and other schools, right, you had academics actually putting pressure on the investing community by saying, Eugene Fama coming out and talking about the efficient market hypothesis, where based on his research, he was saying, there is no magic, you really can't beat the market, even with all your analysis and all your whatever, everyone's got the same information and you're not going to beat the market. And, there's just no advantage here. So there was a lot of pressure. There were a lot of bad news, right? A lot of terrible investment returns, high commissions, bad tax situations, all these things putting pressure on the investment community. John Bogle comes forward. He wants to solve the problem. Charles Schwab wants to solve the problem. Eugene Fama wants to tell people that they're wasting their time with like fancy fund managers and things like that. And it all starts to coalesce and people start to listen. And eventually index funds just take off. This whole passive investing idea just starts to take off. So that's the backdrop. And now we kind of fast forward to where we are now, where there are just so many index funds, and it's, this what people are mostly doing when they look at their 401k menu, they're going to pick, so it can be any kind of index, right? Index basically just means there's no cherry picking, right? So there's going to be some kind of theme, some rules-based theme of like, it could be just mid-cap growth stocks, right? All of them. Like, not pick 15 of them and say, these are the ones that are going to really do it for us, over the next 5 years. You look at the entire universe of mid-cap small stocks, and what an index is basically like, let's just take all of them. I don't want to say it's an average, because then, you have to still say there's going to be cap weighting, right? So if, anything counts as a mid-cap stock, it's going to be in this index. But then the ones that have the larger cap are going to have a higher concentration in the index, and the lower cap are going to have a lower concentration. So whoever came up with this cap weighting idea, it seemed like a good idea at the time, right? And in some ways it makes sense, because how else would you reflect that the better companies that are growing faster, their prices are going up? How else would you reflect that in an index? If you kept everything equal weight, then the companies that are doing better, that are growing, as soon as they move up, you would be selling them. And then you would be buying more of not the losers, but the ones that had the lower market cap. If you tried to keep everything equal cap weighted, it would be a little bit, that wouldn't work either. So the cap weighting kind of makes sense. It's just that it's gotten completely out of control. But anyway, hopefully you're enjoying these pictures from the 70s. But that was the backdrop. Now index funds are all the rage. It made a lot of sense, get away from these brokers, get away from these sort of dream fund managers who are just picking 30 stocks and who knows how they're doing it. Let's just have, whatever the theme is, if it's small cap value, if it's large cap growth, there are all these different themes that you can use. And then there'll be an index fund that, like, the rule is like, we're just looking at this section of the market, small cap growth, large cap value, whatever it is, but we're buying all the stocks that are in there. And then we are buying them on a cap weighted basis. So that's what indexing is. That's what passive investing is. And it's had some really great results. Just more recently, because of information technology taking off, this bet, if you choose the S&P 500 index, you end up with a very, very high concentration of information technology, financials, and healthcare. So it's almost like the cap weighting has gotten out of control. So to get back to basics, to get back to some level of diversification, let's look at sectors. So sectors, they were sort of, they've always been out there, but they were really nailed down in 1999 into these 11 categories. So here we are. These are the 11 categories that make up all the stocks that you're going to find in the S&P 500. Some are going to be energy stocks, materials, industrials, utilities, healthcare, financials, consumer discretionary, consumer staples, information technology, we certainly have covered that, communication services, and real estate. So basically, when you look at the S&P 500, those stock, each stock is going to fall into one of these categories, right? And, there's nothing magical about these categories. It's helpful to learn that these sectors exist, that these sectors are monitored, studied, tracked, right? And then to think, once an index gets out of whack, kind of the first place you look to see if there's a problem, sort of a diversification problem, is by going to the sectors and saying, well, like, how are these sectors doing? Like, what's overrepresented, what's underrepresented, right? Anyway, so these are the 11 sectors, right? In each sector, you obviously have subcategories, right? So I'm just giving you one example. So if one of the 11 sectors is financials. Well, within financials, obviously there's so much going on within financials, right? You have everything from regional banks to insurance, life insurance, health insurance. You have MasterCard and Visa, right? You have credit cards. You have reinsurance. You have transaction and payment services, right? Like the PayPal, stuff. So there's a lot going on inside financials. And what you can end up happening is the S&P 500 can be can have good exposure to a sector, but once you dig down into the subcategories, not great exposure to certain things. So let me see if let me see if I included an example. Here. Okay, so within actually, you know what? Let me go back. I'm going to do that when I talk about what's underrepresented. Okay, so here are the 11 sectors, right? Energy, materials, industrials, utilities, healthcare, financials, consumer discretionary, consumer staples, information technology, communication services, real estate. Then we know for each one, there are going to be these subcategories, right? So just like this is examples of subcategories within financials, but you could go to communication services and see the subcategories are like advertising, right? So advertising is a subset of communication services. Cell phone providers like the Verizons of the world, that's a subset. So you're going to see that there are like extensive subcategories. Now, here is the way, if you want to personally investigate a sector, the easiest way to do it, I just love the Vanguard website. They give so much information with tremendous clarity, excellent graphics. So if you want to investigate a sector, go to the Vanguard website, it's vanguard.com. When you get there, then you're going to see, they're going to say like, well, who are you? Are you an advisor, a financial advisor? Are you an institution? Who are you? And you just click on you're a personal investor. So Vanguard website, then personal investor, then scroll down a little bit and they're going to be like, well, what are you looking for? Are you looking for mutual funds, ETFs? Why are you here? You click on mutual funds, then scroll down again and click on index funds. And then it's going to show you like all the index funds that they have. And on part of this grid, it says asset class. And if you just click on that, what it helps you do is that it alphabetizes it. So then all of the sector funds are lumped together. So they're very easy to find. and so I took a screenshot of the kind of what it'll show you, but it'll show you, it has a fund for every sector. And I'm not saying buy from Vanguard or buy these mutual funds. I'm just saying that if you're interested in a sector, they will give you the best information of what's actually in that sector fund. So once you've done all this, you see, like, here are their ticker symbols for their different mutual funds that are sector based, right? So they have 11 sector mutual funds because there are 11 sectors. And then if you click on any of these, then you go in and it'll show you actually which stocks are in that fund, right? So if you go into communication services, you're going to see that's really heavily weighted to Google, right? And to Meta, which owns Facebook and Instagram, like, not terribly surprising. And it's really heavily weighted to Netflix, right? Yeah, so if you are at all interested in these sectors, I feel like that's kind of the best way to do your research, to find out what's in there. So let me see. I was going to give some examples. Okay, so like if you went to the Vanguard website and you went to, so if you went to like consumer discretionary, for example, and then, you go in and then you scroll down and it'll just tell you like because all of these are cap weighted again. So it's very interesting to find out what are the main holdings of this fund. Because again, like it's the 80-20 rule, right? Like 20% of the stocks get 80% of the assets, right? Maybe not that concentrated. Probably not, more like the S&P where the top 20 got 45%, but you're going to want to see like the major holdings. So for example, in consumer discretionary, if you click on that, you'll find that, and this makes sense because it's, what's at the discretion of the consumer? What's the stuff they don't have to buy? They just want to buy it, right? So, which is very different than consumer staples. Consumer staples are the things like you're not going to go without toothpaste, right? Unfortunately, a lot of people are not going to go without their cigarettes, right? So within consumer staples, you're going to find those things that are like, you're going to buy them no matter what. But consumer discretionary is at the discretion of the consumer. So you're going to find Amazon is the biggest one, right? Because you don't have to shop on Amazon, but we all do. Tesla, Home Depot, McDonald's, Starbucks, Nike, those are the ones in the consumer discretionary category. If you were interested in what's in the staples, consumer staples are one of the few areas that's doing okay right now, right? So in this panic that we're going through, people sort of this flight to safety of like, forget the cyclicals, forget the ones, that do well in a good economy and poorly in a recession. Let's just go to what's the most stable. And that's consumer staples, right? People are still going to shop at Costco. They're going to shop at Walmart. Maybe they're going to get some new customers if this continues. Coke and Pepsi, right? Those are the staples. Cigarettes and beer, those are staples, right? So Altria Group and Mondelez that I think makes Negro Modelo and things like that. Anyway, it's kind of fun to like go in and be like, what's going on with each one of these sectors? And when we get to the point where you see like what's really underrepresented, you'll see like, oh, okay, well, now I got to go back and find out what's within these underrepresented categories. Which stocks are we talking about? What am I missing out on? Okay, so yeah, so let's talk about the underrepresented sectors. As like we said, if information technology is 30% of the S&P 500, and that's only one sector, and there are 11 sectors, then obviously there are a lot of sectors that are getting, very few dollars of the S&P 500 are flowing to them. So here's what's underrepresented of the sectors. Consumer staples is not really that bad. I just threw it in there because it's in the bottom 5 out of the 11. Energy is underrepresented, materials, real estate, and utilities. So interesting, right? Energy interesting. Energy has actually been, one of the real growth areas for this country, but it's not in the S&P 500. And certainly like Exxon and Chevron, those are really big companies to like kind of be ignoring. Real estate is its own very interesting beast. It's so important to be in real estate. David Swenson, who ran the Yale Endowment, he became famous for kind of totally rethinking how endowments should invest their money. So it became like he worked for Yale, so it became like either the Yale model or the endowment model or whatever. But like his theories really changed investing, and he was adamant that not people, I mean, he was dealing with institutions. But he was adamant that institutions should be 20% real estate, right? So, well, what does that mean? Obviously, institutions, it's not about like owning a home. It's much more about like all the ways you can invest in real estate, right? Like cell towers right now are, so the business side of being in real estate, or, with the Amazons of the world, like they have all of these facilities, these kind of storage facilities, all over the world, right? So, it's commercial real estate, but it's not office space, which we all know has not been doing well. But real estate is a really, really big area, and it's almost non-existent in the S&P 500. There's a little bit of a problem with getting real estate easily because real estate investment trusts, which is kind of REITs, R-E-I-T, real estate investment trusts, are not kind of the best way to go when you're trying to get real estate. They do have good income. I mean, if you just want to be doing income, but it's unfortunately it's not so easy to get real estate because for whatever reason, these REITs very often just mimic the movements of the S&P 500, which is surprising because they're such a tiny portion of the S&P 500, but you don't get like the real sweet diversification. So in terms of real estate, I was going to recommend, we did a really, really good video on how to invest in real estate 2 years ago, and it just lives on the library YouTube. But that really covered like, how can you have some investments, some exposure to real estate, well beyond like your home or doing a fixer-upper or things like that, but really looking at the whole landscape. And they're basically kind of like private equity deals. And also there are a lot of online providers now, like Fundrise. It's kind of famous for offering real estate exposure. Utilities, like hopefully everybody kind of understands utilities, that's like your local electric company, your local water company. And, utilities are really usually have fantastic dividends. So it's a true shame to like not have exposure to that at all. So, if you have 11 sectors, then if everything were equal weighted, then like each sector would be 9%, right? So then to be down at like 2.4% for utilities, 2.2% for real estate, 2% for materials, that's really, really a problem. You're just not diversified at all. But, as I said, it's really cool to kind of go and now look at, again, go to Vanguard, then do personal investor, then do mutual funds, then do index funds. Then you'll see this grid. You're just going to sort by asset class, and you're going to get to these. And then when you click on them, you really get to see like where, what are the main companies that are investments here. I mean, I would imagine, I actually didn't do it for utilities, but I would imagine it's like Duke Energy, Southern Company. I think these Southern utilities have been consolidating, and they're massive now. They usually have good dividends. You'll find that these companies have a lot of debt, and that can be a little scary, right? It's just like, uh-oh. But I mean, even in a downturn, people are not going to stop. I mean, they're going to use their electricity, they're going to use their water, they're going to do things like that. I mean, maybe they'll use it less, but these utility companies can also, they really, I mean, can they go bankrupt? Can they go out of business? I mean, they're so heavily regulated, but they can raise their prices. I mean, in any case, you see my point. I'm kind of a fan of utilities, especially if you need the income. But looking at kind of the only thing that I think would really take some creativity is getting exposure to real estate. Otherwise, all you have to do is look at what's underrepresented, go to these different mutual funds and see, like, the stocks that are in there, see what you think, and then, add that to your portfolio. I'm not saying specifically buy this, right? I mean, you can buy individual stocks, but just educating yourself on what's missing, what's underrepresented, and trying to figure out, okay, well, I might, I don't want to be underrepresented for that. Okay. And you can still have underrepresented subcategories in a sector that is otherwise fairly represented within the S&P 500. So the perfect example of this is financials, right? So the S&P 500 is actually like 14% financial. However, it's financial like JP Morgan, MasterCard, Visa, Bank of America, Wells Fargo, right? So these are the largest holdings within the financial sector. Well, what's missing there? Remember at the beginning, I was talking about how Aflac and the Hartford, two companies that have just really hit it out of the park in the last 5 years. So insurance is clearly like underrepresented. I mean, you do have Progressive in the 10th of the top 10, but then after that, it goes back to Morgan Stanley, Citigroup, BlackRock, Schwab, and then you finally get to Marsh & McLennan, but it's just, there's so much of a fall off by the time, when you're the top 15 stocks, because of cap weighting, are just taking up so much of the dollars that you're definitely ending up with a problem with insurance being underrepresented. And insurance is a really good, solid business. And again, probably good dividends. So just keep in mind that even if a sector is well represented, a subcategory of it can be underrepresented. Okay, so what not to do? Okay. If you realize that if you think, well, based on what we've talked about, that the S&P 500 is not diversified enough, that you're missing out, especially if you need income, you're definitely missing out. How to get more diversified, what to add, what to sell, what to add, right? Here's the problem, but here's what a lot of people do. They do sort of a minimal amount of research. They'll read a headline, right? And they'll see that utilities have gone up 20%, in the last year, or consumer staples, the graphic underneath that has lost the least in this dismal 3 months that we're in, where the S&P 500 is getting, slammed. And obviously consumer discretionary looks terrible. Oh, but consumer staples is like kind of holding its own. Or in this other very vertical graphic, if it's like, oh, it looks like, energy is the way to go. Like maybe let's do they're the hottest one. So let's buy that. Okay. I actually can't see. I'm hoping that's what it shows there, because I just, anyway, but the box of all of our heads is kind of blocking that. But here's what you don't want to do. Like if you want to be more diversified, do not chase returns. Do not just look at like what's been working, what seems to be hot. And again, I want to get back to David Swensen of the Yale Endowment. When he was interviewed about like, what's the biggest mistake investors make? He said the biggest mistake is, if he had to pick one, it's, performance chasing, right? Which is what we just talked about. So that's when you look at a headline, when you're like, okay, well, this is doing really well and that's doing really poorly, I'm just going to jump on the bandwagon of the thing that's doing well. Well, that's the opposite of buy low and sell high, right? So you're jumping in the bandwagon. You're buying the stuff that's already been bid up. So not that you should turn around and buy the lowest either, but it's just a cautionary tale. Cliff Asness, who's sort of a famous Greenwich resident of, AQR fame, he says all the time, everyone's doing it. The institutions, the high net worth people, the retail investor, the average investor, they're all chasing performance too much. So what we're not going to do to add to diversity is we're not going to chase performance. And even just like your regular, investing website, I'll just say, just don't chase performance. Like, we are not doing that. So that's what we're not going to do. Okay. So we're not going to do this. We're not going to look at a little headline and be like, oh, okay, I guess the utilities are hot, or energy's hot, or consumer staples is the only thing that's not losing money. We're just going to jump on that, because by the time you read it, you've already missed it, right? So now you're buying the more expensive stuff. So it's definitely better to take a thoughtful approach. So here's, what to do. Well, interestingly, I mean, there's a financial product for every strategy. It's amazing. And they're not necessarily expensive. I mean, sometimes, like, I'm not a big fan of the themes, right? So themes became a big deal. And usually if you look under the hood, you find out they're charging like much higher fees than you would really normally have to pay to get the same kind of exposure. But there really is a product for everything. So once the S&P got so out of whack and people were concerned about this concentration risk, all different kinds of companies that create mutual funds and ETFs, the Schwabs of the world, the Vanguards, the Fidelities, they all provide a workaround. So there are these funds and ETFs. I always talk about mutual funds. Other people would only do ETFs, whatever your preference is, that are called X sector funds. So what you can do is you say, I want the S&P 500, but with no information technology. Now, why would you do that? Well, probably because you already own the S&P 500 and it's very heavily information technology. So now you're going to buy, and own both, right? The S&P 500, but now the S&P 500 with all that information technology taken out. Because when you take out that 30%, then all the other stuff gets reweighted. And maybe that's one way you solve the problem, right? Or you can do X financials, right? So maybe you think the financials are too heavy. You could do X healthcare. So that's one way to handle getting rid of an overweight sector. Another way is to really investigate the different sectors and what's in them, and, pick the ones that you want to emphasize. And maybe you have more of the regular S&P 500, but you add a little bit, a lesser amount. Maybe you have, who knows, $20,000 with the S&P 500, and you're adding $2,000 of just the energy sector, or just the utility sector, right? Or just the consumer staple sector. Your choice. Once you realize how to look under the hood and see what's inside these sectors, these sector funds, why not look at individual stocks? I mean, it's so funny to me that there's a guy, he's a professor, he's a public policy professor at the University of Chicago, and he became famous on the internet because he said that, like, everything you need to know about personal finance fits on an index card. And that kind of took off, went viral. It got so out of control. He's a public policy professor, not a finance professor. And he had some very good advice. Obviously, don't have credit card debt, make sure you save, things like that. But one of the things he said was never own individual stocks. And I thought, well, where is he coming from on that? And it's probably because he knows that there are a lot of people who just behaviorally, they don't have what it takes to investigate stocks, to hold on to them when they're going down, to not, chase performance, right? So that's that's why you have all these people out there and they drove me crazy, like all these 25-year-old guys buying NVIDIA, it's like the hot stock people. Well, I'm assuming that you are much smarter than that and much more self-controlled. And since you have the ability to go into each one of these sector funds and look at the stocks that, because they're all cap weighted, you realize that if you bought that sector fund, you're basically just going to end up with a lot of, in communication services. If you bought just that sector, you would get a lot of Meta, Google, Disney, Netflix, Verizon, right? But you can decide for yourself, like, well, I don't really want any more Meta, like, boy, that stock has really run up. I mean, if you look at like what has been going on with Meta, I mean, it has taken off, but you might say to yourself, actually, Verizon, I mean, that has a great dividend, and that's that hasn't taken off. So I think you can you can look under the hood each of these sectors and make some decisions about individual stocks. And in this world of buy anything you want in any amount with no commission, the fact that we can do fractional shares is astonishing to me. I mean, you really can just do whatever you want, buy any amount you want. You can create your own mini mutual fund, really, of however you want to address the issue of a lack of diversity in the S&P 500. It's just very, very easy to do. So don't be afraid to buy individual stocks, because you can buy them in very small amounts and stay very well diversified, right? Yeah. Okay. So what to do? Look at the X sector funds. Look at the different sector funds. Don't chase returns. Look at individual stocks. There are a lot of ways to really rebalance and have a better balance of the different sectors in your portfolio. Okay. But let's talk about getting even more diversity, right? Because even at the end of the day, if you're fixing your S&P 500 problem by buying into the different sectors, you're still only buying large cap companies, right? So that's what these sectors are all about. These sectors are just the large cap companies. So what if your goal is to have mid-cap companies, small cap companies, right? So there are, again, Schwab, Vanguard, Fidelity, like all the big players out there have funds that are total market funds, right? So you can make sure that you get the total market. So you could even forget about having the S&P and just buy a total market fund. You could very specifically buy a mid-cap index fund, or very specifically buy a small cap index fund, right? So you can make sure you're getting these mid-size and smaller companies very easily. You can also go international, right? So one of the things, oh, okay, I meant to like click on this. So this is sort of this, if you're really taking diversification seriously, these are the quadrants. These, do you have large, if you're doing the S&P 500, you have both value stocks and growth stocks, right? So and basically anything that isn't growth, they're going to call value. So if it's not growing like gangbusters, like an NVIDIA, if it's just kind of chugging along, nice, nice large company with a good dividend, it's probably a value stock. So you're getting that blend in the S&P 500, but you're not getting any mid cap, and you're not getting any small cap, not mid cap value, not mid cap growth, not small cap value, not small cap growth. So there are all sorts of funds out there where you can zero in, and a lot of people like the small cap growth, because that's kind of the up and comers, or the mid cap growth because that's the up and comers. But those are things that you can very easily add to your portfolio in super low cost ways, because Fidelity, Vanguard, Schwab, they all offer these, and they offer them with very low fees. And definitely check the fees wherever you go to get your investments. But also, it's so interesting to think about these other stock markets and how sometimes they're the top performers, right? Like I mean, I personally have never invested in Austria, Denmark, or New Zealand, right? So maybe that would seem really jarring or really unusual, but it's not that strange to invest in Canadian companies or German companies, right? That's not too out there. Israel has some great stock picks. Ireland has great stock picks. It's, why not? Why not get out there, especially when you see that very often those countries do as well or better than the United States. So this home country bias, this sense that the United States is the only game in town, is definitely not accurate. So work on, you really want to work on that diversity. Okay. And again, if income is your goal, I really can't stress enough how the current S&P 500, because of the information technology being 30%, I mean, mostly like the dividends are like measly or non-existent. I mean, let me look on my phone right now. I'm trying to remember. I mean, is Apple's dividend 0.5%? If you don't use the Yahoo Finance app, it is so easy to use. It is so helpful. Just put in any ticker and get everything you need. So I'm looking up Apple right now. And yeah, the dividend is 0.5%. That's not good. I'm sure Nvidia has no dividend, but let me just check. I'm sure it doesn't. But let's see. Oh, come on. Why did they even bother? Their dividend is 0.04%. I would have guessed that they had none, but I guess they do. What about Meta? How bad is theirs? Yeah, 0.42%. I mean, this is basically like not having a dividend. It's really ridiculous. But meanwhile, you can just buy a treasury bond and get, a 4% yield. So, if you're looking for income, plus the possibility of growth, there are so many, especially now with the market turmoil, you're going to see a lot of companies where their dividend is much better than the current treasury yield just because of the market turmoil. Like their dividend was more in line with a treasury, but because of market turmoil, now the dividend is better. Pfizer immediately comes to mind. I'm not recommending Pfizer. I'm not recommending any stock. I'm just talking about dividends. But there are certain companies, I'm trying to think of ones that I've invested in, like T. Rowe Price, definitely has a very solid dividend. UPS definitely has a very solid dividend. Pfizer, I mean, these are all, they're going to, because of the current market turmoil, they're going to have a 5% or higher yield. So you're going to get a higher yield than a treasury. And the opportunity for stock price appreciation growth, especially if this turmoil is short-lived and you can lock in these lower prices now, you would get both price appreciation and the dividend. And that would be fantastic. So with the S&P 500, you are not getting that at all. 1.3% is pretty dismal. So if you can do some investigating and get a 5% or better dividend yield and the possibility of stock appreciation, price appreciation, that would be fantastic, right? So if income is your goal, you definitely do not want to just do the S&P 500. I'm going to go back to, I think, oh, good, here it is. So this is, in terms of like just looking back at the sectors, some sectors offer the potential for dividend income and may be a good way to bring more income into your portfolio. So companies in the utilities sector, the consumer staples sector, and the real estate sector offer some of the best opportunities for dividend growth. So yes, so the whole thing with real estate investment trusts, yes, they just kind of mimic the movements of the S&P, so it's not the same as being into real estate. But if you're just looking for income, real estate investment trusts, in the real estate sector are a really good option. They usually have very good dividends. Utilities, absolutely very good dividends. Consumer staples, I'm surprised. I didn't realize. I'd have to go back. I don't think that's the best place to look. I would start with the utilities and the real estate, the REITs. But if you want dividends, or you could just go that totally different way and just Google things like best dividend companies or dividend darlings or things like that, and get back and bypass the sectors entirely and just go for the individual stocks. But that's what you're not getting in the S&P 500 at all. And just another plug for David Swenson, the guy who he's such a brilliant guy. He really revolutionized investing for institutions, and he also has great advice for individual investors. You want to have this equity bias. You want to be in equities, meaning stocks. You want to do real estate. You definitely want to be diversified, and don't chase returns, and look out for fees. He also really liked, he liked treasuries. He did not like corporate bonds. He really did not like corporate bonds. He makes a very good case about how you just can't win because those bonds are callable. But yeah, I wouldn't want to let this opportunity pass without acknowledging this very, very smart guy. And he's informed a lot of our discussion groups. And also, if any part of tonight, if what I was saying, I try to keep things very basic, but if what I was saying was still complicated, then please take a look at my book. It is a lively and jargon-free guide to getting started, and I will really, really explain all the things about stocks that you need to know to understand everything that we just discussed tonight. My book is available at the library. It's also at Dogwoods, Diane's, and Athena Books. And people who read it say they finally get it, right? It's for smart, it's the basics, but for smart people. So it's not too basic, but it's also not too complicated. And hope you enjoy that. And our next webinar, before I take questions, I just want to make sure you put it in your calendar, May 13th, the psychology of investing. And that should be a really, really popular topic. We hope you join us. And now, did I not do a slide saying questions? Oh, okay. It's time for questions. I guess I forgot to do that very last slide, but I forgot to move that arrow down just enough to question and answer. Now, if you're shy, you can put your questions in the chat. I don't think there is anything in the chat, but if you have any questions about the sectors, maybe what I will do is go back to. So here are the sectors. If you have any questions about the sectors, or any questions about how to look up these different sectors on the Vanguard website, this is definitely what you want to be doing. Anybody?
Hey, Kristen, this has been great, and I love your the tagline "Basic for Smart People." That's really fantastic. Question I have, it's more a general question. Yes, it can definitely, I think, help with identifying various sectors. But what do you think about where we're heading with fintech and AI and helping with diversification and selecting various sectors for your portfolio?
So I never comment on technology. I just think I literally cannot say. I mean, everyone piles on. I think, if you're trying to invest in AI, I'm so sorry. Does anybody else have anything to say? I just think it's incomprehensible at this point. Prices have been bid up. I think you're more likely to get hurt. I guess I just say that it's too hot a topic. I think it's just too late. But I guess I would just look, I would, if Schwab or Vanguard or Fidelity had like an AI play, I would go, I wouldn't do anything single stock. I definitely wouldn't. It's more what I wouldn't do than what I would do. Do you have any good ideas?
So that's interesting. You know, I understand where you're coming from. So you're looking at AI as potentially as a group of stocks or a sector in itself. And I agree with you. Some of them have been bid up. I was thinking about it more of using the technology to help you diversify, to help you pick which one of these sectors you should be investing in.
Well, that's interesting. I actually, there's a guy in town, there's a couple in town that they started a really good business years ago, all about, they kind of cornered the market on IPO research. And he's writing a book. I don't know when it's coming out, but it's along the lines of what you're saying. His book is like, this is how you will find investments now because of AI. Like he's writing the handbook on like how AI is going to change how you select investments. Is that what you mean?
That's exactly what I mean. That's very interesting. Who are you referring to, by the way?
Yeah, I'm very good friends with his wife, Kathy. She's Kathy Smith. I'm kind of blanking on his name. Let me see if I can just let me see if I exit out of this, since I'm doing my screen, I should be able to, hold on, let's see. Yeah, he actually was sending me book covers. So let's see. Where? If I, because I also get his IPO newsletter. Bill Smith, Renaissance Capital. Bill Smith, Renaissance Capital. He writes a whole thing, like a weekly thing about IPOs. But if you Google him, Bill Smith, Renaissance Capital, or even if you wanted to email him, what does it say right here? Oh, this is probably one of those emails that's not the right email. But he loves to tell people about his book, so I'm sure I can give you his email. Let's see. What is it, Bill? Let's see. So Smith at renaissancecapital.com. Yeah, he's writing like the definitive text on it. Oh, did I lose you? I can't hear.
Thank you. Thank you for that. That's very interesting. And I'm sure it will be a topic in the future for a lot of people who care about investing and portfolio allocation and that kind of thing. So thank you for that. And I wanted to say thank you for taking us through this. This was really informative. Appreciate it.
Oh, you're welcome. It's my pleasure. And he's going to be thrilled with your question and your comments. I'm going to say to him, Bill, people want your book. Like and in fact, maybe I'll have to do a little like, briefing with him and say, what's in there? We need to know now. We can't wait. All right. Anybody else? We certainly have a few more minutes. If you're shy, you can always put a question in the chat. Anybody? All right. Well, thank you guys. It's always a pleasure to do these webinars. We hope you'll join us for the next one.
Thank you. Thank you, everyone. And thank you, Kristen.
All right. Well, good night.
Good night. See you next
Thank
month.
you.
I'll send you slides. Bye-bye.